Welcome everyone, and thank you for joining GP Bullhound's Global Tech Market Update. We are happy to welcome GP Bullhound's co-founders and managing partners, Hugh Campbell and Per Ramon, who will present their views on current events. This will be followed by presentations from our sector experts, Johan Roslund, based in Stockholm and in charge of public markets, Jonathan Cantwell, based in San Francisco and head of software, and Elsa, based in Hong Kong and head of Asia. This webinar will be recorded and sent to you via link. Take it away, Hugh.
Thanks, Jennifer. Hi, everybody. Welcome to our first ever webinar. We're absolutely delighted to have, I can see the numbers clicking up all the time, but close to 1,000 founders, CEOs and investors here on this call today. It's amazing. And a real representation of the global tech community that we have. Here at GP Bullhound, we're 120 deal makers across 10 offices. For those of you that don't know us that well, we specialize in advising and investing in the best technology companies all over the world. You can follow us on social media. We're super active across Twitter, Instagram, LinkedIn. And during lockdown, I'm getting lots and lots of pressure from my teenage daughters to launch our TikTok presence. So watch this space. I've got a fantastic lineup of speakers for you today. As Jennifer said, all across our global offices, including my co-founder, Per. We've worked together for 20 years now, and it's a real treat to be managing our way through our third crisis. So we'll see how we fare over the next few months. And after we hear from Elsa, who's our last speaker, I'll pull the discussion together, make a few quick comments on the current deal-making environment, and share 4 tips on making the most of the current market, after which we can dive into questions. A couple of quick housekeeping items. Firstly, on polling, just to make sure you're still awake, we're going to ask you 4 questions as we go through this whole session. And we will collect that information confidentially and share that back with you all. And the second thing is Q&A. We can already see lots of you are active on the chat and also in the Q&A beforehand. We're going to pick up as many questions as we can just after my final presentation in about 40 minutes time. Our commitment to you is that we'll take up no more than an hour of your time. So if you can share that time with us, that's fantastic. And with that, on with the show. I will hand you over to Per to give you a macro view of the world.
Well, thank you, Hugh. Brilliant. I think it's fair to say, Hugh, that we live in unprecedented times as the COVID-19 pandemic is sweeping across the globe from east to west in quite a horrific way. The world economy is already hard hit, and I, for one, believe that there is more to come. Many countries have launched stimulus packages of quite unseen proportions, which will do good. Some will be more effective than others, and I think the economists will learn by trial and error. But putting that aside, nonetheless, the economy will suffer, and the consequences, importantly, will not disappear in a week or 2, even if the virus subsides. This is also a very unusual time in the sense that there will be clear winners and losers. I don't think we will have ever experienced such great disparity between sectors and companies as we will be experiencing in the next few months. Some will come through quite well, others will fall into great structural problems as whole industries, not just single companies. Digital media, software, healthcare, and telecoms, I think, are on the right side of this divide. So look at that with an extra care if you can. As a consequence of all of this, market uncertainty is fueling both fear and greed, really changing between fear and greed on a day-by-day basis with extreme gyrations of markets at B. One should remember, though, that the world is awash with investable cash, which will eventually find a home, whether the home is in forms of aid, production, or investment. However, we continue to see a very difficult trading environment, and I caution you that it is likely to get worse. We have to expect that the private markets where we regularly operate in will not be able to stay insulated for much longer. Take heed. Nobody, I believe, can at this point read whether this is a short V-shaped event or a prolonged economic recession. My advice to the business leaders on this call is to not gamble, but as a company or as an investor in a company, to prepare now for a tough beat in stormy conditions and act prudently. The silver lining as these events unfold, again, is that the sectors where we operate and many of you are less affected than most. Arguably our core areas of subscription software, subscription entertainment, online learning and working, e-commerce, marketplaces, and payments are all potentially even benefactors as more of the general public is made aware of the benefits where we have all on this call been proponents for the last 20 or more years. Our private funds and public tech strategy is holding up well at the moment, and we have to follow that very closely. Therefore, I think if we can keep our wits, our energy, our capabilities, our culture, and our capital, for all of us on this call, we could come out of this stronger. In due course, we will be back to sunny sailing with our corporate spinnakers hoisted, as we've had in the last couple of years. Lastly, I want to mention a project that I personally have been very engaged with over the last 7, 8, 9 days, together with one of our portfolio companies, Ravenpack, a specialist in artificial intelligence for hedge funds, where we have just launched a free-to-use COVID sentiment analysis engine on a public website, which can hopefully help you guide through some of your concerns and how this is trending up and down related to your sector. So it's hopefully something that can be of help, and it's been a big project, and the first time this level of granularity of data is accessible outside of the large hedge fund industry. And I think with that, let me hand over to my colleague Johan in Stockholm, who will tell you more about the public markets.
There we go. I hope I'm unmuted now. So I think we can start off just by looking at the tech sector for the last 25 years. Look and seeing that it has been volatile, but in the long run, tech has outperformed the market more than 3 times. If we look at the start of this crisis and maybe the following recession, we have the tech sector right now being down around 25%, while the most hit sectors like travel, for example, is down around 40%. This is only a 13% difference between those two sectors. And as Per mentioned, a few of the tech companies actually, you could argue, benefit from that people use their services even more. Another thing, why the tech sector could have been hit is the valuation. But looking at next year's estimates, the valuations are down 20%, and the EV/EBITDA ratio is down to 15 times, so around 15 times earnings, which on historical view is pretty favorable for this type of world-leading companies. If you go to the sub-sectors, there are even some areas that, as I mentioned, will be positively affected. So when it comes to food delivery, home fitness, digital health, these areas will both have a structural positive impact, that people change their habits, try these products that they haven't tried before, but they're also cyclical positive. So if we get, which is pretty likely, a recession, these areas are still not hit that severely. On the other hand, we can see, for example, the ride sharing. I don't think people are that keen on getting into a car with an unknown person during these Corona times. Also, restaurants and travel are industries that is not that wouldn't be impacted possibly either in a recession or by the virus. So, where to invest then? Of course, the work from home software, like the Zoom service that we are using now, it's really interesting. However, when it comes to Zoom, as we said in the invite, they are valued to 40 times revenue. So it's becoming really expensive. And if you calculate what each user is worth, the value to over $2,000. Slack has seen a lot of new customers coming in during these times. On Twitter, the CEO announced that they are at a double intake of new customers compared to Q4. Of course, even also home entertainment like Tencent, Netflix, and Spotify will benefit from people having a lot more free time. And also marketplaces like Amazon, Alibaba, and online payments like PayPal when you buy most of your necessities online. And another interesting thing to look at is which of these companies that sits on a lot of cash, because in these times it will be really attractive to do acquisitions. So if you buy Alphabet, for example, 13% of their market cap consists of net cash. And as you can see, all these players have been really active the last 12 months doing 5 to 7 M&As, and you can see some examples there. And with that, I will hand over to my colleague, Johan Cantwell, head of software based in San Francisco.
Hi everyone. Hopefully you can hear me okay. Thanks, Johan. Loading some slides here and joining from Silicon Valley in the morning time. Sure. Okay, first off, we have a slide on our software index. So we track about 75 public software companies globally. And we track them over time and how their valuations have trended relative to a revenue multiple. And so you can see here, over the last 5 years, the average trailing revenue multiple is 8.9x. And forward multiple is 7.3x on average. And as of yesterday, the index actually closed at 9.9x on a trailing basis and 8.2x on a forward basis. So we're still above 5-year historical averages, about 12% above, which is interesting given such a decline in the markets overall. So I think this does kind of prove the point that the software companies in general are faring fairly well. I think part of that is driven certainly by Zoom and other large cloud providers that are benefiting from more people working from home. But you do see in the bottom right that the multiples have come down about 11% year to date on this index. So a bit of a crash there from over the last 3 months. And I'd say historically we've seen several SaaS crashes. So back in February of 2016, there were a number of big companies that missed earnings, and there was a crash. You see the index traded down to just over 4x revenue, which was very low. And then there was another crash about 15 months ago, December of 18, in the midst of some trade war issues, and the index crashed below the 5-year averages. So while we're in a very volatile market, we do think software companies are faring well. We'll kind of see how that transpires over the next several months. We do think, over time, there will be a shift as people go back to work to more kind of desktop work, which is still software based, but maybe less people on Zoom in a few months than say today. So clipping forward, here's actually a bunch of transactions that have happened in the software space actually this month alone. And on the left, you have M&A deals. On the right, you have private financings. So while this pandemic has been occurring for a few weeks, deals in the later stages have gotten over the finish line and have been closed and announced. Just one yesterday, a public take private of an education software company called Instructure was done by Thoma Bravo. And then a variety of financings have happened earlier this month as well. We at GP Bullhound are announcing a deal in the government software space later today that we closed about a week and a half ago. And then finally, just some general predictions for COVID-19 and for the rest of the year. I think a lot of this has been touched on, but we do think high recurring revenue business models will survive well in the long term. Our advice to founders is to focus on what really matters to the customers, double down efforts in those areas, focus on the core business, concentrate their customer success teams on renewals and expansions of the current customer base, as that will be longer lifetime value than, say, spending cycles and resources on new bookings. So a balance is important, but certainly focusing customer success on the current base will be critical. There's been a shift to profitable growth, but we think that will certainly accelerate right now. So important aspect in order to function well without burning a lot of capital. And then in specific verticals, I mentioned we're announcing a government software deal today. We think some verticals will work much better than say others in this current environment. So government, healthcare, those are areas to kind of double down in investments. And then hospitality and retail may have a more troubled time over the next couple months, but then see a huge uplift probably in the back half of the year. Fourth, remote work and collaboration platforms, as we've talked about, has seen a well-deserved increase in demand and stock prices. Zoom has really pushed up the entire SaaS index, as well as a lot of activity on Slack, Microsoft Teams, and Google Hangouts. We think the demand for that will come down post-COVID-19, but will still remain high as a shift to a more mobile economy, less transient way of life will likely stick for years to come. And then finally, as we saw 10, 12 years ago in a recession time, large cloud players will continue to hire and be the dominant forces given their scale. So companies such as Google, Amazon, Microsoft, Salesforce, and then new players such as Zoom and Slack. We think a flight to quality will certainly benefit the tech leaders in general. So with that, I'll shift it over to Elsa in Hong Kong.
Thank you very much, John. Hi, everyone. I will share my presentation here. So I'm sitting in Hong Kong now. It's a little bit late, but happy to be online with everyone. So this first page looks very dramatic, but this is actually what had happened. These are all official statistics published by the National Bureau of Statistics of China. And you can see here a very, very big drop in almost all economic indices across the country. Whether any improvement will be seen in March, we still don't know, but we'll see. But I think we can look at this and think about what might happen in the other parts of the world now that it has become more of a global pandemic. Some of the numbers and facts, I think the number one observation people have seen is, of course, cut back on consumption, on spending in general. No matter how much more masks and hand sanitizers you can buy, you're definitely not going out and buy a car at this moment of time. Another part, of course, are the industries that have suffered most. A lot of them are very reliant on offline traffic. So these include all the travel related industries, hospitality, offline education, retail, real estate, and a lot of offline brands in the fashion and apparel world. Of course, this is not just contained within one market because we're in such a global environment now. So if you think about Chinese purchasing power in the luxury sector, it has always been very, very high. In the past, China accounted for almost 1/3 of global luxury market, and actually more than half of the spending happens overseas. So outside of China, these are outbound Chinese travelers spending in Gucci stores in Paris. But this market is basically gone for the first quarter, and we don't know how much more there would be in the coming year. Some of the data that are not that depressing, one is, of course, we see a jump in the online consumption. So people stop buying offline and they had to buying things solely from online channels. So this caused a 3% increase in the online consumption. Also, due to the lack of channels to actually purchase goods and the lockdown, people do have desire to shop, and people do have desire to spend. So surveys have shown that there is at least $210 billion spending power that's being temporarily inhibited. So hopefully to be released later, both at home and around the world, of course. And as a latest status update, Hubei is already out of lockdown. So people and goods, all the traffic can go freely in and out of Hubei province. Wuhan takes a bit longer, but will end the lockdown by end of next week. So overall across the country, especially in China, the rate of back to work or resumption of production is already close to 100% in a lot of the places. So this is promising in a way. Of course, how much good that can actually do without the rest of the world's help, that remains a question. This you saw a lot of these charts in Johan's slides and also everywhere else. But I think one thing I wanted to point out is the Asian stock market, the secondary markets actually did not react that negatively until it became more of a global problem. So as you can see here. And still, so far, I think the negativity or the sentiment here is still slightly, I can only say slightly, better than probably in the rest of the world. On the primary market side, of course, you do see a very big drop in the deals getting done, both in terms of numbers and value. But interestingly, actually, deals are still getting done. And January and February have historically been slower months, as you can see from the history. And February number actually increased from January. There were a lot of anecdotes and stories about how investors have been getting around the lockdown and getting deals signed. There are stories of Sequoia people hiring a car and driving for hours, going to the founder's home and basically snuck the founder out of the home and into the lawyer's office and signed the contract. So all of those stories, but basically Sequoia alone closed 25 deals in February. And some of them, like Sequoia, just took the chance to actually go out and grab the opportunities. But as you can see, most of the deals are actually done in enterprise services, healthcare, and consumer retail tech. A lot of them are migration from offline to online kind of tech. So this is actually very reflective of the kind of sectors that Johan and John talked about that might benefit from the pandemic. Some of the interesting things we are seeing from the tech world currently happening in Asia, actually across Asia, not just in China. But you know, the migration from offline to online, the realization of you actually need to have that cloud infrastructure and cloud access to enough cloud resource. The focus on automotive, autonomous tech, and on robotics, and also a lot of the what we call stay-at-home economy or otaku economy demands have basically surged. So these could we'll keep an eye on those and see whether these are sustainable trends or just a short-term boom. So lastly, if we look ahead, there are several questions people have been asking. You know, will people actually go out and overcompensate on their consumption, spend all that they haven't been able to spend in the past few months of lockdown after everything has calmed down? It's very hard to tell, because I think one thing we need to notice, there is a significant drop in terms of income and money that's available to spend. And the people coming out of this do have a higher tendency to save and also to buy fixed assets, including insurance products. Permanent change in behavior, we believe there's also, because we are animals of habits. As after these few months of habits being online, actually the data is Chinese have been spending 22% more time on their phones than before the epidemic. So yes, definitely there will be changing behavior, like you will continue to buy things from online and probably paying more in games. Online traffic, probably not all of them are sustainable. For instance, the online education, a lot of them will subside after kids do go back to school. But yeah, as I mentioned, we think it would be very difficult for Asia to just move ahead before without the rest of the world have come out of it. So with that, I will hand back to Hugh Campbell.
Thanks, Elsa. Really interesting overview of what's happening in a part of the world that we hope is, 2-3 months ahead of us. Fascinating. I'm sure we'll have a bunch of questions about that. So I think, as I said before, I mean, this is the third shock that we've lived through here at GP Bullhound since we founded the business 20 years ago. And I guess we can tell you it's always different. It's always really, really tough, but it does always come to an end. However, when uncertainty is so high, it's of course really tough. It's certainly not plain sailing to get deals done, and I'm sure we're all seeing this day to day. As John said, deals are closing, but many of these are, I guess, what I would call pre-COVID deals. But it's interesting again hearing what Sequoia have been up to in China. So the resourceful investors, those people that have a real appetite, a real engagement and relationship with these founders, are getting deals done. But we should, of course, expect to see a huge drop-off in closed deals over the next few months. When we talk to strategics and corporates, depending on where they are in the world, they are active at some levels if they're up in Asia and coming up for air. In Europe and the US, we see them still very internally focused. If you look at Johan's data about share prices, it's perhaps no great surprise. And those corporate development people that are looking at deals are really only looking at them at super attractive levels right now. When we talk to the banks, to the debt guys, they're telling us that the reach out from their clients is more than it was in 2008 in the credit crunch. They think it's much scarier as the economy has stopped in many countries, and their real focus is on their current clients rather than new clients. Everybody, they say, is looking for a bigger overdraft or a term loan to get them through this. And of course, we must remember with the banks, a bit like the governments that we work with every day, that they're exposed to retail, they're exposed to leisure, they're exposed to travel, industries that are much, much worse off than the technology sector. When it comes to investors, they're certainly in no rush. And those that are transacting, again, like the strategics, are looking hard at price and looking for as much downside protection as they can get. I think last week and probably for another 10 days or so, most of the funds we talk to are very internally focused. They're stress testing their own portfolio and trying to figure out who the winners and the losers are in the investments they have already made. Those that are coming up from that will look externally, but we don't yet know whether they will do a digital deal. Many say they will, but only time will tell. What we do know, though, is that those investors will focus on businesses and founders that they've met before, teams that they already understand, and in many cases, perhaps are going to look more domestically for their next investment, where it's much easier to do reference checking on management. And then if you think about VCs versus private equity firms, the VCs that we know are perhaps a bit more used to working more digitally. They have a higher risk profile and a higher risk way of operating anyway. On the private equity side, this type of decision making, living, working, breathing in the digital world is a little bit newer. And so we'll see how quickly they can respond. And of course, for the private equity firms that are more generalist in nature, that are in manufacturing and industrials as well as tech, it may take a little bit longer for them to get a real lay of the land. So before we dive into questions, I think a couple of final thoughts from me. The first is that if you're a founder or an entrepreneur, a CEO on this call, you have to own your own future, your own destiny, and protect your balance sheet at all costs. You cannot rely on governments to bail you out. The queues will be long and the handouts will be slim. If, like us, you believe that in 2 or 3 months' time, activity will begin again, as we've seen in China, then of course, starting a roadshow and starting a level of pre-marketing on Zoom and through Slack is a very sensible thing to do. And so here's 4 quick tips for success if you're going down that path. The first, please distribute early, comprehensive information about your business. Give investors lots of time to review the model, the KPIs, the information memorandum. Don't just send it half an hour before the call. Help them prepare thoroughly. Number 2, try to create maximum impact on video conferences. Don't leave anything to chance. This is tech after all. And I know from just this first webinar experience with you guys that there's a few things we can certainly improve next time round. The third, provide the investors with deeper and more extensive client referencing if you can. More case studies, more quotes, more opportunities to speak to your favorite clients. They're really going to need this if they're going to progress in this much more difficult operating environment. And fourth, we're also seeing investors want to spend much more time on referencing the management team, not just the executive board, not just the CEO and the C-suite, but at a level a little bit further down as well. So prepare the packs of CVs, prepare the referencing, prepare the bios, anything you can do to ensure that investors can dig deeper into the teams that they're looking to invest in, despite not being able to meet. And finally, let's recognize that European public tech is down 33%. So don't be too precious about valuation. Cash is king right now. And for those that can survive through this period, there may be some fantastic opportunities ahead. So with that, I'd like to invite my panelists to pop back up on video. There's Per. Hi, Per.
Hey, and Hugh, just so you know that we've already been answering quite a number of good questions over the Q&A service while you've been speaking. That's
great. Hey, Johan, Elsa, John, great to have you back. So John, a question that I can see here. So how much have SaaS valuations changed year to date? And how do they compare to historical averages? You touched on that a little bit. So perhaps a little bit more on the parallels with 2008. Is this better or worse?
Right. So as we saw on the slides, to date we're down about 11% from the close of last year based on our SaaS index. But based on historical averages, we're actually still up about 12%. So there's still been huge growth in the sector over the last several years, and that's kind of benefited the space today. Versus 2008, it's pretty interesting because you have a lot of new companies. A lot of the big cloud companies today weren't around 12, 13 years ago. And even back then, a company like Salesforce was relatively small compared to where they are today. So it's a much stronger sector overall. I think it's still going to fare fairly well in the future, and there will be a flight to quality and a flight towards selling into customer bases that makes sense right now. And along the way, like I said, we've seen 2 or 3 SaaS crashes, so it's a pretty resilient group.
Great, thanks, John. And Per, I mean, you're running our investment business right now. I made a few sweeping generalizations about investors as I was summing up there. You have any perspectives on how you're looking at the portfolio and new deals right now?
Yeah, indeed. I think your comments and suggestions were very good, and I answered a number of questions kind of in the similar vein. I think for the entrepreneurs on the call is recognize that capital is already much scarcer and will get even much scarcer. So keep your existing investors really up to speed with what you're doing, not just the good news, but also the real challenges. Your best avenue for further funding in the near term will be your existing investors. Be very prudent with your balance sheet. I mean, make sure to make the cash at hand last as long as possible. Expect that your customers may not be paying you even if you have a contract. So think survival. But also remember, don't give up. I mean, the reason you're an entrepreneur is because you can make it happen in any sailing condition. And so be open-minded on terms and be out there. Make sure to speak to people and get your message across. Make sure that you differentiate your story from all others that are looking for capital. And I think when we look at our portfolios, both in the private and the public market, we definitely think runway is something we score very highly. And the other thing we score very highly is activity from the founder team, whether it's a very large company like Slack, where the CEO went out yesterday and shared a lot of his own experience on Twitter, which was beautiful, down to startups like Ravenpack that just launches a completely new service in just a matter of days. I mean, the tough gets going in conditions like this, and I think we are not the only investor who prefer to back that type of management team.
Great. Lots of questions flooding in now, which is fantastic because we have a good 10 minutes before I let you all go. So Johan, question for you. How will the pandemic affect the tech companies dependent on ad revenues? Facebook perhaps in particular, but Google, I guess, to some degree as well.
Good question. Yeah, like we said, those 2 players are the ones hit the most when it comes to valuation. They're both down 30% on next year's earnings. So volumes will, of course, go up. People will watch more YouTube and hang more on Instagram. But when it comes to the ad prices, they will likely go down a bit. For example, for Google, their largest advertiser is bookings and the travel industry, and they will of course go down in advertising. So net, it could be a bit negative for Google, and for Facebook, we're more on the positive side.
Yeah, and I think this is a build on a question from Gaurav, who's asking about the estimate of drop in ad revenue globally. I mean, none of us on this call are Martin Sorrell, who's usually the spokesperson for the whole industry, but I think there's no doubt that it's going to go down significantly. I mean, if only because we're cancelling the Olympics, which of course is an enormous advertising jamboree for 2020, which is now cancelled.
But I think you on that, I mean...
Yeah, one indicator is big digital advertiser advertising companies like Baidu and Weibo in China. They're already alerting in their Q1 results that they're seeing up to 20% drop in ad revenue. So of course that's only digital ads, but that's a sign of it.
Elsa, couple of quick questions, Elsa, for you. So how does COVID-19 change Chinese tech companies' investors' view on the overseas market? Is this an opportunity for them to buy cheaply, or are they remaining very concerned and reserved, do you think?
I think this has actually made them want to go global even more, because they realize as being a single market, even as big as China, is very risky. So actually a lot of them are accelerating their steps to go global. So I would see excuse me, I would see a new wave of Chinese tech companies seeking interesting targets in the West.
Okay, so we should look east for our next M&A and fundraising deal, perhaps. Per, just to bring you in, you had a couple of comments, maybe.
I think it's very important when you are a technology investor to focus on a 3-year plus investment horizon. And specifically when it comes to Google, they're seeing an amazing pickup of Google Meet for schools. So their education business will leapfrog forward, and use of the services are surely at an unprecedented level. Their TensorFlow AI is now being used by researchers all around the world as part of the effort of finding a cure. So while it is true that they will suffer from advertising revenue this year, I think my view is that in 3 years' time, they will be that stronger. The reason that we have a positive view on Facebook is, again, a question of connectivity and usage, not of revenue. In addition to that, our view is also that it becomes now very clear to the world that it's incredibly valuable to be able to communicate, whether it's with your parents or grandparents or people that are sick, or children with each other as they cannot go to school. So I think some of the concerns have been putting negative pressure on the Facebook share price over the last 2 years, that, you know, it's a platform for confusion or political input, will dissipate, and that will give the company a great lift once we're out of the advertising slump.
Great, thanks. I'm going to question for you, John, and then to Johan. So John, you've just closed a deal, a business in the software space. So what additional due diligence do you think investors or buyers are going to seek during this more difficult period? You're on mute.
Here we go. It's a good question. We saw this a lot back 10 years ago as we were coming out of the 08-09 timeframe, and I think we are seeing it now again, you know, today in this current environment. It's just scrutiny all along, you know, A to Z in terms of customer diligence, people diligence. You know, I think we'll see kind of an uplift in looking for ESG related, you know, companies and diligencing, you know, kind of that across the board. So sustainability, corporate social responsibility, I think will even be at more of a forefront going forward in diligence. I think, diligence time periods will also extend a few weeks, compared to the last couple of years.
I mean, it's been interesting in a couple of deals that we're running right now is that once you get through the term sheet stage, you agree a price and push on. Interestingly, the data room level of diligence is moving incredibly quickly because the lawyers, the accountants, the management references, everybody has time. I mean, everybody, at least in the West, is stuck at home and their alternative is to play with their family, their dog, or their partners. So due diligence, once it gets going, has the ability to move very, very quickly. I think the challenge is to what degree is a proper handshake a key element of closing a deal. Thanks, John. Next question for you, Johan. So this says, are forward multiples relevant anymore? I mean, if you're looking at public companies today, to what degree is forward of any value at all?
It's a good question. It's always a lag, of course, and that's why we're careful of using that. But this year is, of course, a lost year. 2021 probably needs some revisions down as well. But if you look at 2022 for most of these companies, you could maybe both a catch-up effect and also an effect from the digitalization being faster adopted. So their estimates could even be too low.
Great, thanks, Johan. And Per, here's a good question from an old friend of ours, Gianluca. Hi, Gianluca. Great to have you on the call. Have we tracked the number of investors pulling out of transactions or renegotiating terms?
Well,
I can take a bit of that if you like.
I think the reality, Gianluca, is that investors that have been very close to the goal line have actually tracked on. So somewhat to my surprise, we've seen both where we've been advisor and outside a number of transactions getting done last week and the week before, and again so far this week. My concern is I don't think that's going to hold up. I think it's the initial instinct is we promised each other, we shook hands, let's get the deal done. I would encourage entrepreneurs, founders, boards, existing investors to be open-minded to changes of terms in order to get transactions done also in the next few weeks. Those with cash in bank will survive and will also have the ability to launch new products and features that may be more appropriate to the post-COVID economy that we don't really yet know how it's going to look.
Great. Thanks, Per. And then we've probably got time for a couple more questions. So one for you, John, around artificial intelligence and machine learning in the startup space. So those that are focused on manufacturing, retail, and other industries, how do you see them faring during this period? Any thoughts on valuation? Are they likely to be higher than the average you've talked about, or lower?
Yeah, I think it depends, in what type of retail. We've seen some companies selling into consumer product goods and kind of, the Walgreens and Walmarts of the world, and they're actually seeing a huge uplift in customer demand. And I think as some other parts of retail, maybe struggle, they will bring down their teams and rely more on artificial intelligence to automate their businesses over time. So another shift towards technology playing a role in the recovery.
And then two quick questions for you, Elsa. The first is a question about Hong Kong now being in a second lockdown. Is that true? What are you seeing day to day on the ground? Why has that happened?
Oh, I think it's mainly because we do have a lot of inbound, imported, confirmed new cases as people coming back, mostly for students studying overseas or people residing overseas trying to come back home, given what's happening overseas. But I think people here are already quite used to the norm, practicing social distancing and and because we have been leading this life for 2-3 months now. So I think it's not that big of a deal in terms of daily life. In terms of economy and sentiment, of course, it largely depends on mainland China and, of course, the rest of the world, given how international Hong Kong is. So mainland China, I think, is on a positive note, and the rest of the world, we'll wait and see.
And if you look into mainland China, this is the last question for today, Elsa, but are you seeing an increased interest coming out of this in digital health? Digital health companies, do they seem to be flavour of the month? Anything the founders in that sector can learn there?
Yeah, definitely a lot of money flowing into health tech, not necessarily just digital health, but definitely on the remote diagnosis, AI, and the software side of the health tech. But also another part is because over the lockdown, a lot of those online health tech companies have acquired so many users than they could ever have at a very low cost than they could ever have before. So this was actually a very, very good opportunity for them to grow. So I think if you are a new business, especially if you're combining AI, robotics, AI or imaging tech or anything around that, there would be a good chance.
Okay, great. So listen, many thanks to my fellow speakers. Thank you all for joining our inaugural webinar. Stay tuned to GP Bullhound on social media to hear about our next webinar. We've got a bunch of stuff coming up over the next few weeks. Thanks for joining and stay safe. Bye for now.